I'm here with Mr. Dan Patton, the Danimal, and I have a few questions for Dan on how you should decide between choosing a variable or fixed rate mortgage. It could be for an investment property, it could be for your principal residence. What are the general, first off, when I say that question, what comes to your mind first off?
The intention of the property, for the most part. I get asked this question every day, fixed versus variable. There's a simple sort of 3 rules that I like that guide me towards the answer of this question, but ultimately it depends on the intention of the property. I like variable for 3 reasons. 1, it's a lower rate. Okay, so right now that spread's about a point to a point and a half, depending on which fixed rate you're going with.
And what's the average kind of spread?
Over the last few years, it's changed. We were in the middle of an inverted yield curve a few years ago, and that was a time where fixed rates were actually lower than variable
Which is
rate.
very uncommon. Right?
Very, very uncommon. Okay. But since then, it's sort of corrected itself, and the variable rate now hovers roughly about a point to a point and a half lower than fixed rates. Okay. So I like that. It's a lower rate, right? Number 2, I like that I can lock it in at any point. So if rates lower, imagine people think, well, if rates go up, that's good. I can lock in my payment. Yes, that's true. But imagine if rates go low and fixed rates start to come back down, you can also lock in the fixed rate that too. So I like that I have the flexibility to lock it in both ways. If rates go up and I get a little worried, I can lock it into a fixed rate. If rates come down and I want to lock it in and take advantage of a lower fixed rate, I can do that as well.
But if rates go up, is it kind of too late to lock it in if they've already gone up?
Well, too late is a point of mind. The spread that's the thing. The spread normally remains the same. So to answer your question, when you go to lock in a fixed rate, you're locking it in roughly a point to a point and a half higher than whatever rate you're in today. Because you're right, in the sense, if variable rate goes up, if prime rate goes up, chances are the bonds have already gone up because bond rates are a little bit more sensitive. They move on rumor and speculation. So chances are the bond rates have already gone up, a week, 2 weeks, 3 weeks before. That's very, very normal, but right before prime rate goes up. So by the time prime rate goes up and we start getting the phone calls from people going, should I lock in? You're exactly right. The fixed rates have come up already, and that spread is still a point and a half. And when you're looking at it, it's like, well, why wouldn't I just stick in variable now and hope that doesn't continue to go?
Well, that's the thing. If the trend is still going up, it still could be good to lock it in before the next increase.
Well, that's just it. That's why, right? Exactly. If you are not to say fearful of rates continuing to go up, right? And remember, rates don't go up and not come back down, just like they don't go down and not come back up, right? This is a cycle. But if you're concerned about that, well, then maybe you take a fixed rate, or maybe you would say to yourself, okay, well, if it goes up to this point, I'm going to lock in I'm going to assume the rate's going to be a little bit higher, and I'm going to lock in my fixed rate at that point.
Okay, so lower interest and the flexibility to lock it in.
Right. And the third thing that I like is the penalty. So when you're in a variable rate, for the most part, your penalty is only 3 months interest. So you always know what the penalty is to break the mortgage. When you take a fixed rate, there's some uncertainty in the penalty. So think about this. Before COVID, when fixed rates were sitting, let's just say fixed rates were sitting at like 3.79, 3.89% on a fixed rate, right? And when COVID hit, prime rate dropped, fixed rates, bond rates dropped, everything dropped, right? Rates dropped. Fixed rates were sitting somewhere around 2%. So everybody that locked into a rate at like 3.89%, 3.99% thought, well, hey, why don't I break my mortgage, take a lower fixed rate? Rates are like 2%, I'll do that. Well, when you have a fixed rate, the penalty can be either interest rate differential or 3 months interest. It's the greater of the two. 3 months interest, we all know what that is, right? 3 months is 3 months of interest. Almost half your payment times 3 is roughly the calculation. And by the way, when you take a variable rate, it's always 3 months interest. But when you take a fixed rate, it's one or the other. So 3 months interest or interest rate differential. Interest rate differential is based on the amount of mortgage you have left, the remaining term on your mortgage. If you're in year 2 of a 5-year mortgage, you have 3 years left. And it's based on the difference of your interest rate and the cost of the bond at the time you want to break the mortgage. So the bank is looking at that as a negative. They're looking at it saying, well, look, if fixed rates today are 2% and we have your money locked in at 3.79, 3.89, we have to break that mortgage and lend that money back out at today's rates. Well, we're going to lose money on that. So we're going to calculate how much money we're going to lose, and that's going to be your penalty. So that's a general thing of interest rate, a general breakdown of what interest rate differential is. That's why you can see penalties of like $20,000, $30,000 sometimes. That's interest rate differential. So you don't know what your penalty is going to be. So for those that say, I go back to my original point, it's about the intention of the home. If I'm sitting there going, Dan, I'm not going to sell my property. I have no intention of selling my property. I'm going to stay here. I'm going to plant it. I just want to sleep at night. I don't want to worry about rates going up. take the fixed rate. If you're looking at it going, I want a bit more flexibility, I may sell, I may break the mortgage, like investors for the most part they just like flexibility and options. Take the variable, because in hindsight, most people will tell you, and if you look at history, the variable rate's lower. That's the history, but it's riskier. So you pay a little bit more to sleep at night with a fixed rate.
Yeah, but you're seeing most investors take the variable.
I'd say 90% take variable. Yeah.
Okay. And then the ones that are taking fixed, what's the general reason that you've kind of picked up on? Is it just maybe they're a new investor, they're a little worried about the interest rate increases?
Yeah, you can offset some of that risk as well. Some banks do have product. It's limited and the rates aren't always great, but they do have product where if the variable rate goes up, the payment doesn't change. So usually people taking fixed rates, are just more concerned about the rates continuing to go up. They're a little bit more fearful. Maybe they don't have the experience in the market. Most people that have been in the market for the last, 5 to 10 years, they see, how prime rate moves, so we don't get a lot of fixed rates. First time buyers more so would be taking fixed rates because they're a little bit more uncertain about the market. They want to know what they're paying. And, when I was a first time home buyer, I took a fixed rate, but now that I've been in the market for a little while, I tend to lean towards variable because I see the advantages.
Yeah. My first investment property, it was during that inverted yield curve, and I locked in my fixed rate because it was lower at the time. I think it was 2.69 and variable we're going for, I don't know what it was, maybe 3.5 or something.
Yeah.
So I took that, and I think just a year and a half later, broke the mortgage, and it was a $20,000 penalty. And I told myself not making that mistake again.
That's
so
the thing.
Variable from here on out for me, just because of that flexibility. And now that I'm more experienced as an investor and stuff, I'm ready to kind of take on that so-called risk. What about the penalties to break a B-lender mortgage?
Depending on the term, a little bit more restricting. If you take the thing with the B lenders, you're normally taking 1 year terms, right? Maybe a 2 year term, but you're generally not taking terms longer than that. So you'd have to tell me, is the plan to break it within a year? Because I can cater to that. I can get a 6-month mortgage through a B lender. So usually with B lenders, you're not as concerned. I shouldn't say it like that. Maybe not as concerned, but you have a little bit more flexibility. You're looking generally, if you take a 1 year term with the B lender and you try to break it prior to 6 months being in, you could be paying a 6-month penalty. So you'd have to, right? But why would you buy a house only to sell it 6 months later? Well, maybe you're doing a flip, or maybe you're doing renos. Well, that's okay. There's a product for that. We can get you in a 6-month term, or maybe even an open term where the rate's a bit better. So penalty with the B lender, it's not to say it's not as relevant, but we'd have to understand the game plan, right? A 1 year term that you can renew after 1 year is, gives you a little bit of flexibility to revisit everything every year. And if you're taking 5-year fixed rates with A lenders, that's the thing. It's 5 years. B lenders, you're 1 year.
Okay. And so if someone's working with like you or your team, and I should have mentioned at the beginning of this video for anyone who doesn't know Dan, that Dan's a mortgage broker with BM Select. If anyone's working with a mortgage broker, how important is it that they let you know the game plan of what they intend to do with that property? Because it seems like you guys would then be able to give recommendations based.
Well, and it's a really good question because, we like to call ourselves, real estate planners, right? And for me to be able to plan your purchases and plan, the finances, I got to know what your story is, right? People set up mortgages for different ways. It's not as easy as just go get me the best rate. Because if you have plans on breaking the mortgage, if you want to do a BRRRR strategy, if you want to have access to lines of credit, if you want to do 30-year amortizations, you want to have discounted variable rates, like those decisions may dictate the lender you have to go to. So for me, I have to understand what it is you're trying to do with your portfolio, with each purchase, how many properties are you trying to get? Super important to me, because without that, then you're just shopping for an approval. And that's not quite what we do as a brokerage. As a brokerage, we work more with investors, who require a bit more planning, a little bit more sensitivity. Investors, maybe that don't realize this, that own multiple properties. The second you own more than one property, one owner occupied, and you're trying to buy a rental, every bank is a little different now on how they see your application. So when you go to the bank to borrow money from them on a mortgage and you own one property and you're buying a rental, they're all very different. So you have to go to somebody who not only understands how to work with, the banks within the broker channel, but they work with the banks outside the broker channel too. So again, that's part of the planning. If you want to come to somebody like myself and say, Dan, I want to, grow my portfolio from, 0 properties to 3, or from 3 to 5, or from 5 to 10, tell me what your plan is so I can help tell you how to either structure each mortgage along the way or which banks to go to, have the advantages of, that I'm a big bank guy, have the advantages that a big bank might provide.
So would there be that much of a difference between building a portfolio of 5 properties versus 10 and how you would structure things right from the get-go? Or kind of minor at that point?
No, it's still important, from 5 to 10. 5 is sort of a key number when you're an investor. Banks start to, have a little bit of issue once you have 5 properties. From not every bank allows you to hold more than 5 properties. So 5 properties is sort of a key number to a bank. So for an investor who wants to scale to, past 5 properties, sure, you want to, you have to have some sort of a plan in mind. There's maybe some banks you want to try to go to first because they allow a limited amount of rentals. You want to go to them first and leave the ones who allow 10 rentals for later on, right? So there's a little bit of planning involved there for sure.
Cool. That's all I wanted to know. Thanks for that. That's great, Dan. Thank you so much.
Man.